Alright guys, we're here in the second part of my report. Options 2. Option pricing. Option pricing theory estimates the value of an options contract by assigning a price, known as a premium, based on the calculated probability that the contract will finish in the money, ITM, at expiration. So ITM, guys, means in the money. So ITM, one with a strike price that has already been surpassed by the current stock price. So ito siya option pricing. The following factors influence the price of an option. So first is the behavior of financial prices. So the behavior of financial prices, one of the key assumptions made by the Black Scholes model, or BS, in that asset prices follows a log normal distribution. So mo na siya behavior of financial prices. The second one is the strike price. So strike price, the difference between the strike price and the underlying price of the asset at the same time of the option. Is struck will influence the size of the premium. So the third one is volatility. The volatility of the underlying asset will influence the probability of exercise. This is considered in detail below. So nasa mga formulas ani guys. The fourth one, the term of maturity. The term of maturity, a longer date options has greater time value and a greater probability of event. So volatility. The volatility is the underlying asset that influence probably the term of maturity na data, guys. So term of maturity, a longer date option has a greater time value and a greater probability of eventually being exercised. Then the last one is the level of interest rates. So the level of interest rates, the premium paid for an option is theory represents the expected gain to the buyer at the time of option exercise. The Black Scholes options model. So the Black Scholes option model requires 5 input variable. The first one is the strike price of an option. The second one is the current stock price. The third one is the time of expiration. The fourth one is the risk-free rate, and the last one is the volatility. Usually accurate, the Black Scholes model makes uncertain assumptions that can lead to prices that deviate from the real-world results. So assumptions. The BS model describes a process of calculate the fair value of European call option under a certain assumptions, and apart from the prices of underlying asset and the time, all the variable in the model are assumed to be constant, including the most crucially the volatility. So that's the Black Scholes option model. So there are the following assumptions are made. So the first one are there are no transaction costs or market allows short selling. Trading is continuous. Underlying assets prices follow geometric Brownian motion, with the variation rate is proportional to the square root of the asset price. Then the fourth one is the asset is non-dividable paying security. The fifth one is the interest rate during the life of the option is known as constant, and the last one is the option can only be exercised on expiry. Interest rate option and the Black model. In 1976, Fisher-Black represent a slightly modified version of the BS model, using similar assumptions to be used in pricing forward contract and interest rate options. So scholastic volatility refers to the fact that the volatility of asset prices varies and is not constant, as is assumed in the Black School options pricing model. Scholastic volatility modeling attempts to correct for this problem with Black schools by allowing volatility to fluctuate over time. Then the last one is implied volatility. The implied volatility is the market's forecast of a likely movement in a security's price. IV is often used to price options constructs where high implied velocity results in options with higher premium and vice versa. Supply and demand and time value are major determining factors of calculating implied velocity. And that would be all, class. Thank you and God bless.
And now we are going to discuss about options 3. We continue with options in this chapter with a look at how options behave in response to changes in the market conditions.
Assessing time value. The time value of an option reflects the fact that it is the highest for at-the-money options and also higher for in-the-money option. Out-of-the-money call option, for instance, presents the lower probability of exercise for the market maker. Therefore, she may not even hedge such as the position. In-the-money call option carries a greater probability that it will be exercised. American option is a style of options contract that allows holder to exercise their rights at any time before and including the expiration date. An American style option allows investor to capture profit as soon as the stock price moves favorably. Measuring option risk, the Greeks. These are termed the Greeks as they are called after letters in the ancient Greek alphabet. In this section, we review these sensitivity measures and how they are used.
Delta measures the degree to which an option exposed to shifts in the price of an underlying asset or commodity. Delta hedging is a trading strategy that reduces the directional risk associated with the price movements of an underlying asset. Gamma represents the rate of change between options delta and the underlying asset price.
Theta, the options measures the extent of the change in value of an option with change in the time of maturity. The theta value impacts certain option strategies. Theta is an option, Greek, that measures the rate at which the option loses its time value as the expiration date draws near. It is also the rate of the decline in the option price over time. Vega. The vega of an option measures how much its value changes with the changes in the volatility of the underlying asset. It is also known as the epsilon, eta, or the kappa. A vega measures the amount of increase or decrease in an option premium based on the 1% change of implied volatility. Vega is a derivative of implied volatility. Implied volatility is defined as the market's forecast of a likely movement in the underlying security. Rho. A rho of an option is a measure of how much its value changes with changes in interest rates. Rho measures an option's sensitivity to changes in the risk-free rate of interest or the interest rate paid on the U.S. Treasury bills and is expressed as the amount of money an option will lose or gain with a 1% change in the interest rates. Lambda of an option is similar to its delta in that measures the change in option value for a change in underlying price. The lambda is the Greek letter assigned to a variable that tells the ratio of how much leverage an option is providing as the price of that option changes. This measures is also referred to as the leverage factor in some countries' effective gearing. Caps and floors are the option and interest rates. They are commonly written on LIBOR or another interest rate such as Euribor, the US prime rate, or commercial paper rate. In this section, we review caps, which are essentially calls on an interest rate, while a floor is a put on an interest rate. Cap is an option contract in which an upper limit is placed on the interest rate payable by the borrower on a cash loan. The limit is known as the cap level. Cap option is the maximum possible profit for its holder. When the underlying asset closes at a beyond or a specified price, the option automatically exercises. For cap call option, the option exercises if and when the underlying closes at above or a predetermined level. Floorlet is essentially a put option on an interest rate with a sequence of floorlets being known as a floor. A floorlet is a component of an interest rate floor, a derivative instrument that effectively prevents the interest payments on an otherwise variable rate loan from falling below on agreed level.
Sir, I am Annalie Calumba. I am going to report about credit derivatives. Credit derivatives is a financial contract designed to hedge credit risk exposure by providing insurance against losses suffering because of credit events. So, ang credit derivatives kay usa siya ka kontrata between two parties para na assurance ang gapautang as well as namutang sa mga possibilities na mahitabo. Next is technical default. Technical default, it is a delay timely payment of an obligation or a non-payment together. So, the obligor, in this case, the obligor delay in time of payment but still intends to pay in time frame of another 1 to 3 months. So, na-delay na siya og bayad but still he intended to pay it in 1 to 3 months. Next is actual default. Actual default, it is in default and declared as being in default. So, since the obligor intends to pay, it cannot considered as actual default. But maklasify dira siya as actual default when it is being declared that it is default. So, maklasify dira siya as actual default kung siya mismo moingon nga it is default. Next is reducing credit exposure. So it is a bank can reduce credit exposure for either an individual loan or a sectoral concentration by buying a credit default swaps. So if ang customer naka-encounter siya unexpected financial problem, a bank may seek to reduce its credit exposure to mitigate these losses that may arise from potential default. So for that instances, ang nangutang nga na-miss niya yung pagbayad will be forced to pay a penalty fee or a higher interest rate on the future purchases. So this practice reduces the overall credit exposure to the card issuer. So next is credit default swap. Credit default swap is the most credit derivatives in CDS. This sometimes described as swap or default swap. Next is cash settlement. Cash settlement is the contract may specify predetermined payout value on the occurrence of the credit event. So in this case, kay ang cash settlement kay diba for example na yung mangutang ka sa usa ka bangko. So pwede ra og through cash settlement na dili na kamo ato dito nga ikaw mismo mo bayad. Next is physical settlement. Physical settlement, on occurrence of a credit event, the buyer delivers the reference asset to the seller in return for which the seller pays the face value of the delivered asset to the buyer. So example sa physical settlement kay sa do exam para sa among case, sa do exam nangutang mi og appliances and then sila mismo mo inihatod sa ilang nga product sa balay. Dayon sa months nga amo ang mubayad mi nila kay sila mismo muadto dito maningil. So ingon ana ang physical settlement. Next is credit linked notes. A standard CLN is a security usually issued by an investment grade entity that has an interest payment and fixed maturity structure similar to vanilla bond. So it is a financial investment that allows the issuer to transfer specific credit risk to credit investors. Next is total return swaps. A total return swap, sometimes known as a total rate of or rate return swap or TR swap, is an agreement between two parties to exchange the total returns from financial assets. This is designed to transfer the credit risk from one party to another. So example, after 1 year, if LIBOR is 3.5% and S&P, example rin na siya, 500 appreciates by 15%, the first party pays the second party 15% and receives 5.5%. The payment is settled at the end of the swap with second party receiving a payment of 95,000 to 1 million. Pero depende rin na sila kung sa ilang agreement to ha. Next is reduction in credit risk. A TRS conducted a synthetic report is usually undertaken to effect the temporary removal of assets from the balance sheet. So this can be done by entering into a short-term TRS with say 2-week term that straddles the reporting date. So in this case, it is a temporary removal of assets from the balance sheet. So, meaning you're going to make your amount lesser. So, kinahanglan ka mo remove temporarily sa imong mga assets. Next is CDS portfolio indices. Since 2005, CDS indices product have given investors the opportunity to express views on portfolios of credits across world regions and also by type of credit, investment grade, high yield, and crossover. So, CDS is the example na yung uska investors that owns 1 million corporate bond issued by a private housing firm. So, if there's a risk, ang private housing firm na default siya pag repayment. So, ang mahitabo, ang investors kay palito niya ang CDS from a hedge fund. The CDS is worth of, example, 1 million kuno. Ang investors siya yung bayad sa interest sa CDS o depende po siya bilang agreed amount to the buyer of the credit default swap. So that's all. Thank you.
So, good day everyone. I'm Dura May Olabarrio, and this is the continuation of Miss Anali Calumba's report. So let's start. Index tranche market. The tranche market is now the most common way for an investor to gain exposure to leverage corporate credit risk. The index tranche market trades in both a standardized format and a bespoke format. So bespoke format means that the creditors can customize their investment by selecting the portfolio constituents, the attachment and detachment points, currency, maturity, and target rate. So CDS index tranches are synthetic collateralized debt obligations based on a CDS index where each tranche references a different segment of the loss distribution of underlying CDS index. So, and the main advantage of index tranches relative to other CDOs is that they are standardized. The CDS Big Bang. To help standardize single-name CDS contracts, the International Swaps and Derivatives Associations, or ISDA, introduced a number of documentation changes in its Big Bang of April 2009. So, this helped to standardize both the regular coupon payments made by single name CDS and the defaulting contingent payments. Next is the CDS and points upfront. Points upfront or just points refer to a upfront fee as a percentage of the notional. So, for example, CDS might be quoted as 3 points upfront to buy protection. So this means that upfront fee is 3% of the notional. So points upfront na siya side. So if the points are quoted as negative, then the protection buyer is paid the upfront fee by the protection seller. If the points are positive, it's the other way around. Next, general applications of credit derivatives. A credit derivatives is a financial construct that allows parties to minimize their exposure to credit risk. Credit derivative consists of a privately held negotiable bilateral contract traded over the counter between two parties in a creditor or debtor relationship. So this allows the creditors to effectively transfer some or all of the risk of the debtor defaulting to a third party. So this third party accept the risk in return for payment, so known as the premium. The next is use of credit derivatives by banks. So banks and lenders use credit derivative to remove the risk of defaulting from a loan portfolio in change for a paying referred to as a premium. So bank have a comparative advantage in monitoring credits and hence in bearing credit risk. So by using credit derivatives, bank keep the loan on their balance sheet. So that's all, and thank you.